Mortgage rates, not mortgage rates, interest rates to continue to go up, and you're saying housing prices go down. So out there, is this the time for real estate? People have been looking at real estate. Real estate has been a gem of an investment over the last couple of years because we benefited from low interest rates. Now people are asking the question, is this the time to jump into real estate? People are looking for opportunities. But right here, we're going to pay attention to the interest rates because the Mortgage and Bankers Association put out 2 days ago. No, today, I'm sorry. Mortgage applications decreased in the latest MBA weekly survey. So we're going to talk about why not these interest rates, but why these applications decrease. What does this mean as an investor, and to see if there's any opportunities. But ladies and gentlemen, if you haven't done so, all the time it is, please go ahead and make sure. Hit the subscribe button, hit the bell icon, hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned into the Investor Show. As always, this is host of Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And if you are catching this broadcast live, log in and tell me where you're from. All right. So, ladies and gentlemen, right here, the Mortgage and Bankers Association put out today. Somebody over there on Facebook. I don't know why it's not telling me on Facebook who it is or where they're logging in from. But hey, thank you for tuning in over there. Then we got somebody on YouTube that says, hello, Demon. What's going on? Hello, Demon. Thank you for tuning in. He says, at a 7.4% mortgage rate in 1999, at a 1.33 acre home in Portland was going for $180,000. Now at 6.8% mortgage rates, they are selling it for $1 million. Make it make sense. So right here, he said, Prince, make it make sense, man. You're talking about back in 19, hello, Dom, you know what time it is, man, inflation. The prices have gone up. And you got to think about it. We live in a very low interest rate society. Hello, Damien. When you're looking at interest rates being so low, just talking about 2-3 years ago, interest rates were at 2%. Some people got 1%. When you have interest rates very low, what does it do to asset prices? Sorry about that, y'all. I had a little. Y'all give me 1 second here. Had a little technical difficulty. Y'all give me 1 second. Let me turn this thing off and turn it back on. All right. Y'all give me 1 second. I'm trying to. How do I turn this thing off? There we go. We got rid of those. Now I'm going to bring it back because I'm going to read this for y'all here. So sorry about that little glitch that I had there. That happens sometimes. It's technology. I don't have it happen a couple times or whatever. But hey, we're still here. And I don't know why I does not want to share my screen tonight so I can read the screen at the same time. And of course, my phone wants to ring. Everybody wants to call me. Come on, There we go. Goodness gracious. What's going on tonight, man? Okay. I thought it'd be late night. I'm surprised y'all up and in here. But right here, hello, Damien, what we're talking about, when you have very low interest rates, it pushes the prices of assets up. Because he's saying, hey, at 7.4% mortgage rates in 1999, a 1.33 acre home in Portland was going for $180,000. Now at 6.8% mortgage rates, they're selling for $1 million. You got to think about it. From 1999 to 2022, that's 23 years. The Federal Reserve wants inflation to go up 2% a year, right? So you're talking about inflation now running at 8-9%. So when you're looking at this, everybody's enjoying these big asset prices, but you have very low interest rates and you have inflation out of control. This is why you're saying, these home prices go up so high. On Facebook, he said, this is Al. What's going on, Al? That's my guy in Denver, always holding me down. This is Kenan Anderson, said they're from Texas. Kenan J. Anderson, thank you for tuning in from Texas on the late night show. Hello, Danny comes back. He says, true, but if mortgage rates are skyrocketing again, that should bring prices back to kind of where they were before. I'm guessing what he's saying. You're right. That's exactly what's happening. That's what we're going to get into, right? Because guess what? When you have interest rates that high, right? Oh, I said it wrong, Kyle. Kyle, I'm sorry about that. Kai Anderson. He says, there you go, Kyle. Okay, cool. Now, Hello, Damie says, when you have interest rates go up, what is this going to do to house prices? It's going to start to cool down the home prices. That's the whole point of raising up the interest rates, because we have inflation. As the Federal Reserve continue to chase these interest rates and keep moving them by 75 points each week or every 2 weeks, you're going to see stocks. Have you seen stocks this year so far? All the major indexes, S&P 500, Dow Jones, NASDAQ, coming down. You're seeing home prices coming down because you're seeing people withdraw from buying a home because they're saying, hey, that $500,000 house, that was cool at 2%. That $500,000 house was cool, all right, at 3%, but at 5, 6, 7%, I can't do it. So you're seeing people starting to back out of those particular things. So let's read what they put out here in the Mortgage Bankers Association. This is a place I like to kind of keep my pulse on real estate here. So right here, so I like to take a look how many people are applying to get a home right now. So the mortgage application decreased by 3.7% from 1 week ago, according to the data from the Mortgage Bankers Association weekly mortgage application survey for the week ending in September 23rd. The market composite index, a measure of mortgage loan application volume, decreased by 3.7% on a seasonal adjusted basis from 1 week ago. On an unadjusted basis, the index decreased 4% compared with the previous week. The refinance index decreased 11% from the previous week and was at 84% lower than the same week 1 year ago. So you're seeing this whole refinancing. Ain't nobody refinancing for obvious reasons. Take me, for example. I got a 2.75 on my home. Do you think I'm going to refinance for a 6% or something like that? No, right? The seasonal adjusted purchase index, decreased by 0.4% from 1 week ago. The unadjusted purchase index, the unadjusted purchase index decreased 1% compared with the previous week and was 29% lower than it was the same week a year ago. So for prime example, they're going to tell us what we already know here that we've been talking about already on the show. Applications for both purchase and refinances declined last week as mortgage rates continue to increase to multi-year highs following more aggressive policy measures from the Federal Reserve to bring down inflation. Additionally, ongoing uncertainty about the impact of the Fed's reduction of its MBS and Treasuries holdings is adding to the volatility in the mortgage rates. The 30-year fixed rate was 6.52, its highest level since mid-2008. After a brief pause in July, mortgage rates have increased more than a percent point over the past 6 weeks. Right? This is coming from Joel Klan, the NBA Associate Vice President of Economic and Industrial Forecasting. With the rates now more than double what they were a year ago, the pace of refinancing is running at a 22-year low, and last week was more than 80% below last year's level. Simply, purchase activity was 29% lower than it was a year ago, with higher rates and the economical uncertainty weighing in on buyers' decisions. So as we see these interest rates start to go up, what do you think this vulnerability starts to do? Right? Guess what people are now open to do that they never was open to do before, right? Let's see. Hello, Damon said, James got to come back on and talk about BPT. Yeah, you know what? I'm going to put up a clip about it. He was on a show. He talked about crypto, our Hawaii show that we did last week. And at the end of the show, he did speak about oil. I may take that clip out and put it back on for you for oil, right? Talk about that oil. Because, oil has been the whole market's getting beat up. But the good thing about BPT is it was so good for me in the beginning of the year. But I'm collecting a nice dividend and we're going to see what happened. He said, I like the video, y'all. He said, I like the video, y'all. Help Prince out is free. Okay, yeah. I think he's saying, yeah, like the video. Yeah, Yeah, definitely hit that like button as y'all come in. So here we go, ladies and gentlemen. When you're looking at this, guess what people are open to do that you heard back in 2008 that people were doing, and it sounds so crazy. Here it is right here. With the recent jump in rates, the ARM share reached a 10%, of applications, almost 20% of dollar value. ARM loans remain a valuable option for qualified borrowers in this rising rate environment. So, ladies and gentlemen, the ARM, these are the adjustable rate mortgages, right? They call them ARMs for short for the acronym, of course. But guess what? This means that the interest rate that you have, it can adjust, meaning that it can go up, it could go down. It's not fixed. For prime example, I have a 275 fixed forever, right? For 30 years. Versus if you get an ARM today, because the ARM usually gives you a lower interest rate today. People are jumping in and getting an ARM today. And guess what? As interest rates continue to climb, they don't know what the interest rate is going to be next year or 3 years from now, 5 years from now. But people are getting into ARMs because they are probably offering the lowest rate right now. Let's pull it up. Let me pull it up right here. Let me see. I should have done this before the show. Let's look at the 30-year ARM. Well, would that even be the I don't think there's no such thing as a 30-year ARM, is it? It can't be. See what it says. Or 1-year ARM, because it could adjust throughout the time. Let's see what the adjustable rates. Okay, look at this, right? The adjustable rates for the ARM right now is talking about 6%. Some places are putting up 4%, right? So the 30-year right now is going at 6.43. The 15-year is at 5.66. The 10 years at 5%. 0.4, 7.5. So for a percentage lower, which would lower the person's mortgage rates, it'll help them get into the house. But then they end up owing all this 2-3 years from now. This thing may jump from 6% to 8% to 9%. Why this is bad? This is what led to foreclosures back in 2008. Who remembers this? People said, I had so many friends that jumped into homes. They got a house. Everything was good. A year later, they said, man, I can't even afford the house. Why can't you afford the house? Man, the interest rate just went crazy. Why did the interest rate go crazy? Man, I had an ARM, an adjustable rate mortgage that I got in to get this low rate, but then it just blew up on me because I got this ARM because that was the only way I couldn't afford the particular mortgage. Now, people who flip houses use this all the time. If you're flipping a house, a person's thinking, man, I'm only going to have this house for a couple months. I'm going to buy this house. I'm going to renovate it for the next 6 or 7 months. I'm going to get the lowest interest rate possible. And then I'm going to have it sold before the new rates come out. Hey, it works for them if you know what you're doing and you got luck on your side and God on your side that's guiding you through your investments, which I hope everybody does. And it works for them. But for the person, some people out there just trying to afford a home, they're like, man, the house costs $500,000 at 7%. But if I get an ARM, I can afford it, but not looking at the long-term effect of how you're seeing these things start to come back and get crazy, right? These things are starting to come back and bite people later on in life just to get them into the house again, right? We've seen this happen. This is deja vu. So let's read a little bit more. That's something I saw that was very interesting when I saw this 10% of last week of 10% of the loan applications came in with an ARM. Now you look at the refinance, right? The refinance share mortgage, nobody's refinancing. It decreased 30% week. Nothing surprised there, right? The share of total FH8 loans went down 12% from 13%, right? The average contract interest for a 30-year mortgage confirming loan balance of $647,000 or less increased to 6.52% from 6.25%, with the point increase of 1.15 from 0.17. So, people who are buying their houses for $647,000 and lower, right? So, hello, Damon, you asked me earlier, Prince, man, these houses was going for $180 back in 1999. Now they're going for $1 million. Look at this right here, what it's telling you from the Mortgage and Bankers Association last week. The average contract interest rate for the 30-year fixed rate mortgages with a conforming loan balance of 647,000. People are spending 647,000 on average, averaging out there 500 across the nation, right? So you're seeing, what was this average you talking about 20 years ago? It was way lower. Interest rates are way higher too. But now you're seeing interest rates are getting, the housing market interest rates are going back to what they were back in 2008. So there you go. So, you're seeing, but one of the things I'm seeing right here, Prince, why are you paying attention to this? Why do I care? Why are you seeing this? Ladies and gentlemen, you're seeing those prices. You're seeing how interest rates affect everything that is around you, right? And a good thing that I'm looking for as an investor, I'm looking for foreclosures. I know so many people went out here and stretched themselves thin to get into these houses. Now people are jumping into arms. Things that was bad back in 2008, we have forgot, and people are jumping into arms, and these arms are going to be detrimental within a year or two, which is going to put a lot of foreclosures and houses back on the market. So if you got money saved, you got some good credit, save it and wait for this good opportunity that I think is on the midst of us in the next 12 years, not 12 years, 12 months to a year. You're going to see a lot of layoffs start to happen, people losing properties, all those type of things. And this is one of the things you're seeing, less people apply for applications, put in applications for homes now. All right. So there we go. We're seeing these mortgages, these interest rates starting to take a toll on the beloved real estate industry. All right. Well, ladies and gentlemen, that's going to be my time today. Don't y'all forget, hit that like button, show some love, help a brother out. You're right, man. Shout out to my guy, Kay, who said, hey, make sure y'all hit that like button. Y'all coming in here. I'm seeing everybody coming in here and liking and commenting, all that good stuff. Make sure y'all come in and hit that like button and that subscribe button and share this all around. And thank y'all for tuning in to this late night episode. The NBA reports that mortgage applications continue to decline as interest rates hit their highest level since the mid-2008. 7%. Woo. Well, 6%, 6.52 when this came out, but now it's like 7%. But anyway, ladies and gentlemen, boys and girls and children of all ages, y'all know what time it is. Make sure you hit that like, subscribe, comment, and share button. And if you haven't done so already, make sure you hit that description box below and make a contribution to the book drive, the Wesley Learns book drive. Every dollar you donate will be matched all the way up to 10 grand by the Contribute app. This is going to get the Wesley Learns book series about investing, credit, and insurance into the hands of kids all across the globe. But if you've been thought about it, if you haven't done it yet, help a brother out. What are you doing? To the next video, podcast, cartoon, whatever else y'all see me do around the globe. Y'all know my name, Prince Dykes. I'm the Prince of Investing. And before I get out of here, of course, Jason came in here and just said something. So Jason Turner said, why did it take so long for the Fed to raise interest rates? They have been doing it slowly. They're just becoming more aggressive. They started, I want to say, the beginning of this year. They was waiting when they just saw interest rates going up. They were raising it a little bit. So this is what happened. Back in 2000, they cut interest rates. 2020, I'm sorry. They cut interest rates because of the pandemic in order to stimulate the economy. They pumped all the stimulus money into the economy. Now they're starting to see inflation. They were scared to raise inflation in a weak economy. We already was in a pandemic. So as the pandemic kind of started to fade away, they started to slowly bring up the interest rates. Then they saw inflation going crazy, so they became more aggressive with the interest rates. So they were doing it slowly, like 25 base points here, 25 base points, 50 base points. Now they're jumping up to 75 base points because inflation is at 40-something year high. So they're just becoming more aggressive. They've been doing it, Jason. They're just turning it up. All right. But anyway, ladies and gentlemen, to the next video, podcast, cartoon, or whatever else crazy you see me do around the globe. Y'all already know my name. I'm the Prince of Investing. Peace. Be safe. I'm out, and thank you.